What if today's tax rates are the lowest you'll see in the rest of your life? Not a hypothetical, not a scare tactic, a real question based on where the country's finances are right now. Because if that's true, then everything you're doing with your taxes might need to change. And by the end of this video, you'll understand exactly why.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. Here's a question most people have never been asked. If today's tax rates are in fact the lowest you'll ever pay, what would you do differently? Would you keep deferring everything into your 401k? Would you keep measuring success by whether you get a refund? Would you keep letting your IRA grow untouched, knowing that the government gets to decide their share later? Or would you start thinking about taxes in a completely different way?
That's the shift we're going to walk you through today, because there's a difference between lowering this year's tax bill and lowering your family's lifetime income tax bill. And those are two completely different thoughts. They're two completely different strategies.
So we find most people think about taxes once a year. They sit down with their CPA,
which almost doesn't happen anymore because most of the meetings are, you drop your taxes off and you pick them up.
CPA says, you got a refund or you owe a little bit. And that becomes a report card. Got a refund? Good year. Had to write a check? Bad year. But here's the thing that the refund tells you almost nothing about, whether you're winning or losing over the long run. The sugar high feels good in the moment. It's just not a strategy.
The real strategy is this. How do you fill up the lowest tax brackets as often as possible and minimize the times you're stuck in the higher ones? Not for a year, over a lifetime, and potentially over multiple generations. That's what we mean we talk about the informed tax code versus the uninformed tax code. There are two tax codes in this country. One for the people who understand how to use the tools available to help them, and one for the people who don't know the tools exist. The difference isn't income, it's not net worth, it's simply knowledge.
And according to the research from the National Bureau of Economic Research, the top 1% of income earners legally reduce their effective tax rate significantly using strategies that most people have never heard of. Meanwhile, tax rates are at historic lows and most people aren't taking advantage.
So why do we believe taxes are on sale? Let's start with the math. The federal government is carrying tens of trillions of dollars of debt, close to 40 trillion right now. And that number is growing by roughly $2.5 trillion each year. That's called the annual deficit. It's the gap between what the government collects in tax revenue every year and what it spends. At some point, we think that gap has to close. And there are really only two levers, right? You can cut spending or you raise revenue. If you raise revenue, that simply means you raise taxes. Now, does that mean taxes are definitely going up? Maybe not. Nobody's got a crystal ball, but we've seen this movie before. At times in history when we've had similar levels of debt, tax rates were much higher. In this country, in the 1980s, the top federal tax rate was 70%. Before that, it was even higher. Today, the top tax rate's in the mid to upper 30s. That's historically low. And if you believe the debt math eventually forces tax rates higher, even modestly, then every year you wait to take advantage of this year's tax rates is a year you can't get back. It's use it or lose it.
And here's a reality nobody likes to talk about. The top 50% of income earners in this country pay almost 97% of all federal income taxes. So if you're watching this video, you're almost certainly in that group. So when people say tax the wealthy, and a lot of people say
just about everyone,
they're talking about you. Right or wrong, that's the direction the math points. And the real mantra, if we're being honest, is tax everybody wealthier than me. It's not politics, it's math. And it's something worth planning for. If you're starting to see your tax picture differently than you did 5 minutes ago, subscribe. Because this is the kind of conversation that can change what your family keeps over the next decade. And there's so much more to cover.
Let's get practical. If in fact taxes are on sale, what do you actually do about it? It starts with one question. Your homework assignment. Go out and go into your balance sheet or your financial statement and figure out how much of your wealth has never been taxed. Think about it. Your traditional IRA, never been taxed. Traditional 401k, never been taxed. Traditional 403b, 457 plan, the gain portion of your deferred annuities, none of it has ever has the tax paid on it. So all of this you've been probably deferring for decades. They probably plan on deferring for additional decades. And the government's been letting you because they know that pool money's only getting bigger. They're a co-investor in all of our retirement plans. And then on top of it all, they get to decide the rate that you pay when you finally take the money out. We often say that the government is your partner in your retirement plan. They're going to tell you their partnership interest in the year you withdraw the money.
So let me put a number on that. If you have $1 million IRA, your statement says $1 million. But after federal and state taxes, that account is really worth somewhere around $700,000, maybe $740,000. The other $260,000, it's a government. They're just letting you hold on to it for now because people get lulled to sleep by how much money they think they have. But a chunk of it was never theirs to begin with.
So let's talk about income. There are really 4 types of income to think about. Framing this should probably help you understand things a little bit better because understanding these concepts is key to the whole strategy. So first, there's ordinary income. For most people, it's wages or interest or ordinary dividends. It's things that are taxed in the federal tax brackets. Second, we have tax-deferred income. Now, again, it's not taxed till you ultimately take it out, but it's a category that we have to plan for. And this would be things like traditional IRAs, traditional 401ks, tax-deferred annuities. Typically it's growing, but it hasn't been taxed to date. Somebody's going to have to pay that tax someday. It's either you or your kids. Third, capital gains, but specifically long-term capital gains on investments held more than a year. They get preferential treatment, lower rates than ordinary income. There's something called qualified dividends that fall in here too. And then fourth, tax-free accounts. This would include municipal bond income, Roth IRA distributions, certain life insurance loans, money that if you structure it correctly, it never gets taxed again.
The strategic opportunity is figuring out how much of your wealth sits in each of those categories, and then moving money from the tax later columns into the tax never column, while rates are low enough to make it worth doing. That's the game, and it takes time, planning, and honestly, a little courage.
Yeah, I mean, we've written the checks to the IRS, and it's a little unnerving when you stroke the check. But come April 15th, you get your tax return, and I found it to be a big relief.
Because it means paying some taxes today that you could technically put off until tomorrow. But if tomorrow's rates are higher, you'll be glad you did.
And there's one more reason, and this one's urgent. It's one that people just don't think of typically until it's too late. If you're married, you and your spouse share a set of tax brackets. They're called married filing jointly, and it's where most married couples file their taxes. And these brackets are wide. We talk about the size of the buckets. The buckets are bigger. They give you room. They give you planning opportunities. Here's the problem. Every married couple eventually becomes a single taxpayer. When one spouse passes, those brackets get cut in half the following year. The Medicare surcharge that we talk about, IRMA, those thresholds get cut in half as well. And the income, it typically barely ever drops because you would usually lose a Social Security. Oftentimes,
The lower Social
Security. Oftentimes, we recommend pensions have survivor benefits. But you have the same amount of money in IRAs that require distributions, the same amount of dividends, typically the same amount of capital gains. When the spouse dies, all those get cut in half. But the income, as we said, probably stays the same. So what we think is if you're married, we think taxes are really on sale because none of us are getting out of here alive. And if you're a surviving spouse for a long period of time, it's a big deal.
which happens more often than not.
And, it could be easily a decade on average. Because the day you become a single filer, the math changes. And we'll cover this in detail in another video. But the point is this. The window you have right now with today's tax rates, today's tax brackets, with both of you still here, that we think is an actionable window.
So let's bring it together. We believe taxes are on sale, right or wrong. We believe the national debt makes it likely that rates will go higher.
Have to go higher.
And we believe that the families who act now, who fill the lower brackets, who convert to Roth, who get money out of tax-deferred accounts strategically, will pay significantly less taxes over their lifetimes than the families who wait. Doing nothing's a plan. We just don't think it's a good one.
If taxes are on sale, the question is, are you buying strategically? like you would everything else.
If you're thinking, I've been deferring taxes for years and nobody's ever asked me whether that's still the right move, or if you're wondering what your retirement accounts are really worth after the government takes their share, we'd be happy to walk through it with you. Click the link below and please schedule a conversation, because investing is the easy part. Knowing when to pay taxes and when not to, that's the hard part.
And that's where we think the real money is made. And if the part about married couples becoming single taxpayers caught your attention, it probably should have. Because that scenario is one of the biggest, most overlooked tax increases in retirement. And it's almost certain to happen. The next video shows you exactly how the math works, why even experienced accountants miss it, and what smart families are doing about it right now while both spouses are still here. Click here and watch it now.